In this video, I want to talk about how to use classic technical analysis indicators. I often come across the fact that traders take classic indicators of technical analysis, use those strategies that were originally designed for indicators and trade according to them, and it would seem to be the right thing to do. You pick up some tool, use the instructions on how to use it, and trying to profit from it, because that's how it's supposed to work. But in fact, many technical analysis indicators were invented in the last century. For example, in this video, I want to talk specifically about Bill Williams' Alligator. And this is an indicator that was created back in the 50s and 60s of the last 100 years by mathematicians, financiers, Bill Williams. And his rules for its operation were described decades ago. And needless to say, markets are changing. Today's markets don't move the way they did when trading wasn't as common and wasn't available to a large number of people. Now the markets are much more efficient, much smarter, and a lot of better strategies have been invented in the meantime that we can use for our trading. And let's talk specifically about Bill Williams' Alligator. And in this video, I'm going to talk about how I use it, what strategy I use specifically, why it brings more results. I will also give some tips on how to use this classic technical analysis indicator. So, Bill Williams' Alligator is a system of 3 moving averages with different periods 21, 38. These are the periods of the different slides. The fastest moving average is green. It has a period of 8, and it is the fastest to react to chart changes. And it's called lips. The Alligator moving average has a period of 13, in this case pink in color, and it is called teeth. It is a little slower to react to the action, to the change in the chart, and in this case it serves as a controlling indicator, which help to work due to the interaction with the fastest moving average and sliding. The middle one is the so-called jawline. It has a period of 21, and it generally indicates the direction of a trend and a limit on that trend. Next, we'll talk about how the spacing between these lines is still important. But now, let's run through the basic principle of Bill Williams' Alligator, which is the principle that most traders in the world trade by. So, this trend indicator, it shows us the emergence of a long-term trend in the market. And as a general rule of thumb, when we have all these 3 lines distributed in some sort of order, in this case, we have the slowest, the middle on top, the fastest on the bottom. And when these lines do not cross, it indicates to us that there is a trend in the market, as they are positioned from fast to slow from bottom to top. That's a down trade signal, a falling trend signal. That's the kind of signal we would have on this Bill Williams Alligator. And if we were only using the basic strategy, we would only look at the first distribution of these straight lines and would not enter the trade again throughout this trend. And all this movement would have been missed, because according to the general rule of the strategy, we would have closed the trade only when the chart crossed the blue line. And here we would have probably even recorded a loss. The bottom line is that the Alligator gave us the right signal for a long-term downtrend. The trend was indeed very long and very good, but the general rules would be to close right here and miss all these entry points. Let's look at the opposite example. Here's what the Alligator signal for a rising trend looks like. We have all 3 lines spread out again, but now they are arranged from slow to fast, bottom to top. And that tells us that we have a bullish trend signal. Here we would also enter using the standard up strategy when in a fast market. When the lines are mutually intertwined with each other, we don't have a clear trend or a clear trend of any kind. When these lines are intertwined, this in the general description of the strategy says that the Alligator is asleep and it is better not to trade in new markets. The Alligator, like other indicators, performs very poorly in new markets. It's the long-term trends that we need. Here's going back to that motion. How would you use it so that you don't just use the main signal, but multiple times? That's why alligators enter the market. And the strategy I want to tell you about is called this navigator strategy, which helps you capitalize on each of these bounces. And it is built on the fact that we analyze not the initial alligator indicators, but the crossing of the charts of these moving averages. Let's look at this with a concrete example. We need the moment when the chart crossed the green line and came back up. It is important to us that the chart does not go completely over the blue line during this time. We focus only on the lips and teeth of the alligator. So to us, the alligator initially signals down, and you can also use at will. But at this particular point, you should have been out of the deal by now. And I recommend you to wait for the moment when the alligator crosses the green and red line. How's that for a case like this? And after a while, it will come back below the green line. This is a confirmation signal that the chart has gone back to trend, that the correction is over, the chart has gone back to trend. And at that point, we open an additional trade down. That is, instead of one deal, we made 2 positive deals on this movement. The opposite situation with a rising trend, when we have the alligator showing the initial signal, the lines have opened up. Now we wait for the chart to return to the green and red line area. Here we have this intersection, the correction is over. Now we are waiting for a confirming signal for the chart to move back beyond the green line level upwards. That's the confirmation we get right here in this moment. And this is where we open a buy trade. The same thing, the same principle can be used. And here we see, again, a crossing of the green line and an attempt to cross the red line. This is again a correction. If at this moment we see that the chart has again gone beyond the level of the green line, it rose above the green line again. At that point, we can make another buy deal. Here is such a strategy, which is based not on the usual alligator signals on the distribution of lines, but on the crossing of the charts of 2 fast-moving average alligators. Now let's give you some more tips on this strategy. Alligators. Also, it is not only the fact of intersection that matters, but also the distance between the lines. The higher this distance, the greater this distance, the stronger the market moments, the stronger the momentum down or momentum up. Therefore, you can use the narrowing of the alligator line as a signal to exit a trade or to fix profit. When they narrow at this point, you can fix profit. The same thing, you opened a trade at this point and you see that the line is starting to narrow by this point. That is, the distance between the edge lines of the alligator becomes smaller. And here, we can use this as a signal that the trend is already fading, and here we can lock in profits. Wait, on these trades that I advise you on this strategy with the rebound from the fast, the moving stop in this case should be placed above the blue line for down trades. For example, right here down here, we put just above the blue line. And on the upside, trades you should put a little below the blue line. In this case, if we are dealing with the correction with a full-fledged reversal, the chart will work on our stop and we fix a small profit, a small loss, and vice versa. Here, if the chart would have grown strongly above the blue line, our stop would have been triggered and we would have recorded a loss. This tells us that the chart is reversing. It's better not to be in such a deal. Further, I also advise to use the principle of top together with oligarchs. That if we, let's say, open a deal here, stop, put a little above the blue line, then further along with the fall of the chart of the blue line will decrease, and properties can be moved together with the blue line closer and closer to the price. For example, if our stop is triggered at this moment, as it was on the chart, then even though the stop was triggered, we still made a profit on the trade because we entered here initially, and now the stop is already in the positive zone. Even if we start to have a trend reversal, we still lock in a smaller but profit. Same thing on the trade up if we open a trade up here. Therefore, we signal our strategy stop just below the blue line and move it along with the upward movement of the chart. And our stop would have been triggered. That's the point. That is, we would have entered the trade from here to this point where the stop was triggered. It would still have been a profitable trade even though we had a loss limiter triggered. Trend strategy. Therefore, it is best applied on assets that move more frequently. In trend, it can be cryptocurrencies, major currency pairs manager class. Gold and commodities are also trending higher. It should not be traded on, but on assets that are frequently observed. Mostly bonds or commodities. that have no clear direction. I usually recommend picking just the new assets. Working, I recommend 15 minutes. But for beginners, it is better to choose 0100 or 0400, then the quality of signals will